Hi, today is May 5th. I'm continuing with my lecture on Chapter 4. I'm just finishing up on page 74 right now. And as you can see on the slide from the last lecture, we're dealing with, I'm going to try running this real time. There we are, with some results that I pulled from McDonald's balance sheet. First of all, yesterday we defined par value. And there were three other terms that I want you to know: authorized, issued, and outstanding. These are all terms that you'll see associated with stock according to GAAP on a balance sheet. You'll usually see authorized and issued. Outstanding is one that you'll have to calculate. Now I'll define all three of those for you, again, using McDonald's numbers. The words in green up there, again, were right off their balance sheet for 2012, okay? Authorized, first of all, is how much stock that McDonald's has been given permission to issue by the Secretary of their State of Incorporation. So when I first incorporated my company, I requested that so many thousand shares be released. It doesn't mean that once the Secretary of the Commonwealth gave me permission that I had to issue them all, okay? McDonald's did the same thing. They asked that this issue of common stock include 3.5 billion shares. And there are many reasons that a company will ask to have more stock authorized than they intend to issue. In other words, give to you so you can give them your money, okay, right away. So McDonald's has gotten permission to issue up to 3.5 billion shares. They have decided for their own reasons that's how much is authorized, okay, in accounting terms. They have decided for their own reasons to issue only 1.6 billion of those shares, okay? So that is a stock that they have decided to issue to the investing public and in return receive their money. What they'll do with the other stock, the other 1.9 billion shares, that's up to them later. There could be a variety of things they intend to do with it, okay? They may need to raise more money later. They don't want to have to go back to the Secretary of State again, so they're holding these in reserve. Okay. So that is the amount of stock that's issued, and we saw that number as well as how much was authorized right in the equity section of their balance sheet, okay? All right, lastly, what is outstanding? Okay, now you'll notice back in the preceding slide, okay, that common stock in the Treasury at cost is 658 million shares. Okay, now a company, once it has issued stock, as you learned in financial accounting, can choose to purchase it in the open market right back off the street. And there are a variety of reasons they may choose to do so that I won't get into right now. But if a company does buy its own stock, that stock is placed in what's known as the Treasury, okay? It doesn't count as issued stock. Any stock that the company has, its own stock, does not vote, and it doesn't receive a dividend. To do otherwise would not make sense, okay? So if you take how many shares have been issued and put out into the trading public's hands, and then subtract any treasury stock, that's a negative equity item on McDonald's balance sheet. If you take away from the amount issued any treasury shares that McDonald's currently holds, which we saw a moment ago is 650-something million of them, then the difference between those two numbers gives you how much is outstanding. Outstanding stock means it's been issued, and it is in the investing public's hands, not counting what McDonald's themselves has, okay? Now, again, that outstanding number is important because those are the number of shares that will receive a dividend if one is declared. By the way, McDonald's pays a very high dividend. And also, those are the number of shares that do have a vote. So it's important for you to know all three of those terms: how much is authorized, how much is issued, and how much is outstanding. I'm not going to hold you too deeply responsible for this information, but consider it more of a personal me to you type of thing. This is something you may want to know. Capitalization. Capitalization refers to the total number of shares that have been issued and outstanding multiplied by the current market price per share of that stock. That gives you an idea of the market's view of how much this company is really worth. Now, the reason that's important to us is because that helps us understand the size of the company with whom we're dealing as shareholders, okay? Mutual funds. We've described mutual funds already, where you, as a potential investor, want to pool your money in a big fund with thousands of other people, both rich and working class people who are saving. Okay, and that fund will invest in hundreds, maybe thousands of different stocks, achieving diversification for you. It's also managed by a professional, and it's very liquid. So you may want to specialize in what type of stocks that fund buys. They can be very large companies, known usually for paying dividends. They can be smaller companies, known more for paying for growth, their stock's potential. So capitalization is a way for you as a potential mutual fund investor to get a feeling for the size of the companies in which the fund invests, okay? Older people like myself might choose to invest in larger cap stocks, mutual funds I should say, because they're more conservative, they pay a nice stream of dividends. Younger people, like yourselves, may choose to go the other way and look for capitalization that's lower because they're younger companies, more aggressive, they're poised for growth. And, for example, if you're involved in a 401k fund with your employer, they may give you a list of different mutual funds, some more conservative than others. They will have different capitalizations. So you'll hear terms like large cap, medium cap, small cap income, large cap growth. There are all kinds of mutual fund subdivisions. Okay, I'm not going to explore that any more deeply, but if you do have questions, get in touch. So again, capitalization is how many shares are in the market's hands multiplied by the market price per share. All right, so it's a representation of how the investing public shows the true value or what their opinion is of the true value of the company. Okay? All right, so I've just described all this for you. All right, now please remember, fluctuations in stock prices, that is not in the hands of the company. The only thing that's in the hands of the company, unless they've invested through treasury stock, let's forget about that, is how much in the primary market they issued in stock and how much cash they got for it. After that, the value of the stock is in the hands of the public. I've gathered the opinions of several experts about where the cutoffs are about capitalization size. Companies known as mega caps or funds known as mega caps are those that have capitalization of over 200 billion. ExxonMobil is a good example of that. Okay, a large cap, they used to just be 3 back in the old days, small, medium, and large, and now there's a slightly bigger rainbow of these things. Okay, large cap is anything over 10 billion, so a mega cap would be a type of large cap, all right, but now it's got its own classification. An example would be General Electric. Some of the examples here you might never have heard of. I hadn't heard of 2 of them. Mid cap usually means their capitalization is between 2 and 10 billion. Small is 250 million to 2 billion. Micro, again a fairly new term, is anything below 250,000. And now there's a new one called nano cap. Usually that means billionth, okay? And that's anything below capitalization of 50 million, okay? So those are market cap guidelines. I am not likely to ask you a quiz question or a homework question about these. But as an investor, it's worthwhile for you to know these things. Okay, there are different brokers you can select. This is another type of public service announcement for you. These are names that I'm sure you know of: Edward Jones, Morgan Stanley, Wells Fargo. I've had some bad experiences with a couple of these companies, and others I think very highly of. It's not really proper for me to identify which, because my poor experiences were probably isolated. But my point is that full service brokerages have their place for you. But after taking a course like this, you may not necessarily need one now that you know a little bit more about how mechanics work, okay? You can use a full-service brokerage for other things, but to just make trades for you, you might not want to go to one because they'll charge you a higher cost generally, that's a general rule, to make a trade for you. My recommendation would be more along the lines of, now that you know more about how stocks operate, is to use a so-called discount brokerage. My favorite is Charles Schwab, but because I can't focus on only one, unless it sounds like I'm getting a commission from them, I'll also mention Fidelity. That's another good firm. And of course, you can trade online. The line between discount brokerages and online brokerages has gotten pretty fuzzy these days. But you know the names, TD Ameritrade, E-Trade, and Scottrade are a few. So I recommend that you get in touch with a brokerage, such as Schwab, and get your money out of a bank. What a bank will pay you is not enough to keep up with inflation. Keep enough there for your convenience, okay? But the bulk of your savings, you should open up an account with a firm like Schwab and just park your money there. Okay, your money's safe. You can write checks against it, just like a checking account. They will pay you interest on it. It'll be better than a bank. Okay, and then when you see a stock that you want to pounce on, you can pick up the phone, call Schwab, and say, take X number of dollars out of my account and buy 1,000 shares of Verizon, whatever. Okay, so your money is there waiting, and Schwab will follow your instructions. Okay, and your money is safe there and will pay you interest even if you're just keeping your cash there in the meantime. Okay, they will charge you much less than a full-service brokerage will, generally speaking. Okay, financial managers I do believe in, but there are an awful lot of people out there who call themselves financial managers. After 41 years in finance, I still do not feel I would qualify to become a financial manager. It requires a very specialized area of study, and I am a very serious investor, so I've taken on some of that role myself. But you may wish to delegate that to an expert. Make sure that expert is certified and ask him or her about their track record, okay? But they do certainly have their place, along with your accountant and your attorney, okay? Make sure you vet them very carefully. Okay, this is what a stock certificate used to look like. This gentleman, Archibald McConaughey, I think is his name, decided to buy 10 shares of Canadian Pacific Railroad, and he would receive a piece of paper like this that proves him as the beneficial owner of those shares. All right, now that's very passé. We tend not to trade in paper anymore. It has a lot of inconvenience associated with it. Shares can be lost. If you want to sell the stock, you have to endorse it, you have to return it. It's just not a convenient way to deal anymore. So nowadays, when you open that account with Schwab or Fidelity, they'll hold your shares for you in their so-called street name. Everything happens electronically. Does that mean you don't have evidence? No, it doesn't. When you deal with these firms, whenever you make a trade, whenever you buy or sell something, number one, they're going to document it for you and send it to you. Secondly, every month they will send you a statement indicating what went into your account, what came out of your account, what your beginning and ending balances were. It's going to give you a summary of all of the status and ins and outs of your account, okay? That works perfectly. I use it myself and I highly advise it. If your stock pays you a dividend, that can be credited directly into your account for you. It can sit there as cash. You can draw it out through writing a check to yourself, or you can instruct the company to plow it back into more shares of any stock. That's all up to you, okay? Your flexibility with a firm, a financial firm, is going to be substantial. All right, now this is not a tax course. There are advanced degrees in taxation. It is an ultra specialty, as your accounting professor might have told you. There are graduate degrees in taxation. And we have an association with Bryant College here at Dean, where you can enter their graduate programs with some significant advantages. So it may be an avenue you wish to proceed along. Now, I am not a tax expert. I know enough to be dangerous. But they say whenever you make a financial decision, you should consider tax aspects. So therefore, I'm going to show you just enough about how taxation on capital gains and capital losses works, so you are informed about what your real income will be from trading. Now, unlike your income from your job, okay, we call that active income. You're doing something to earn wages, okay? That's taxed at one rate and in one manner. However, something a little more passive. If you buy and sell stocks or other types of financial instruments, like any item that you buy, hold, and then sell. When you do that, that's known as a capital gain, whether it's artwork, rare music, precious metals, and in our case, capital stock, okay? You buy it, it grows in value, you sell it, and the spread is a capital gain, right? If you lose money, that's a capital loss, okay? And it's taxed in a different fashion than active income, okay? And of course, that means the Internal Revenue Service and your state government will want a piece of it. Capital gains generally, not always, but generally are taxable. Whenever an economic benefit has been generated like this, usually the government wants a little share as well. Okay? And usually capital gains taxes will be lower than the tax you pay on your active employment income. And there are a ton of rules surrounding it. I will not get into those rules. My goal here is to show you a very general picture about how taxation happens on stock gains, okay? All right. Realized versus unrealized. If you have paper income, in other words, you buy a ton of stock and it sits there and grows and grows and grows, they send you a statement and you see, hey, I'm getting wealthier. Do you pay a tax on that? Generally, again, there are always exceptions. Generally not, because that paper income is known as unrealized. It looks like a gain, but you haven't realized it yet. You haven't actually sold that stock and generated income. So the Internal Revenue Service generally ignores things on paper like that. It's only fair after all, because if you haven't sold the stock, you haven't generated any cash with which to pay the tax. Now, there are some important exceptions to that. Again, I will discuss as we go, or you can write to me about them. Realized income, that's the one the government's interested in, because that means you do sell the stock, you do get the proceeds, and the government wants a piece of the difference between what you sold it for and what you originally bought it for, okay? So that's realized gain. The government will tax you even lower on long-term gains than they will on short-term gains. Why? Because it's in the government's best interests for people to invest. So if your money stays in the system longer, more than a year, by the way, long-term versus short-term is defined as a year. Long-term is a year or more. Okay? Sooner than that is short-term. So if you do that, the government will reward you with a lower tax rate for keeping your money in the system a longer period of time. Okay? Now we're going to use this assumption, ladies and gentlemen. You're going to buy 10 shares of Verizon. You buy it 5 years ago. You pay $40 a share, and you have to pay a commission to do a buy or a sell. Okay? That's a cost of doing the trade. So now you bought 10 shares at 40, that's $400, plus you had to give the broker a $25 commission. So your basis is $425. You get to add the cost of the trade to your basis. All right, this is the spread on which you'll be taxed. By adding the 25, you just brought this number up a little bit. You shrunk the amount of space on which the government will tax you. Okay, now today, 5 years, that's a long-term capital gain. You're going to sell it for $10 a share higher. You're going to sell it at 50. That's $500, 10 shares. Plus, you have to pay a 6% commission to your broker. Now, that means you're going to have a $500 transaction. The broker is going to take their piece right off the top, right off the proceeds. Okay? So that's going to be $30. So your $500 shrinks down to $470. They send you the $470. Okay? Will you be taxed starting at $500? No. You're going to be allowed to deduct the commission and only use $470. So this is $500, this is $400. All right? We shrunk it like this, and we shrunk it like this. So you're only going to pay a difference on the net proceeds, not on the gross. Make sure you add your commission in at the beginning and deduct it at the end when you make the sale. All right. There's the spread between the selling price, the selling proceeds, and your basis. The amount of taxable profit that the government will consider is going to be $45 only. If it weren't for the commission, you'd sell for $500 and you paid $400. That's $100 of taxable income. But instead, you get to deduct the $25 in and the $30 out. That's $55, leaving you a spread, a net spread of $45. And now that is going to be the basis of your trade. I'm sorry, the basis of the tax on this trade. So you'll pay less tax, okay? Generally, that's how it works. They call that being recognized. You realize the net profit you realized the gross profit of $100, but you recognized for tax purposes and reality purposes, because you did pay those commissions, only a $45 taxable spread. Okay? My timer went off. That's all for the moment, so I'm going to stop and save this, and I'll post another lecture in a little bit. Stand by. Talk to you in a bit.